Welcome to the Chartered Financial Analyst Level 1 video series, and as usual I provide an introductory slide about my qualification and experience. We will continue on the topic of corporate finance and equity, and this is the video number 11. In this video we will continue our discussion of the cost of capital, and we will move on to the cost of equity, the cost of debt, on the second part of the video. When it comes to cost of capital, we will look into two items. The first, the impact of cost of capital on the capital budgeting. How much investment opportunities are available to us? The relationship between cost of capital of a company and the level of budgeting for capital investment on one part. And then we will look into the impact of cost of capital on the security valuation of the company. When I say security valuation, I mean the value of the share of the company and any other securities issued by the company, such as bonds, debentures, and other convertible debt. So let us jump right into it. As I just mentioned, when it comes to cost of capital, we have two topics. Within that part, the cost of capital impact on the capital budgeting. What that means? How much new project I can plan for the next year. That means budgeting means a plan for next year. Budgeting of capital expenditure or revenue expenditure, that is the meaning of budgeting. Budget is a plan for the next year. So how much capital investment, how many projects, new project I can take given my cost of capital? Before moving on, if my cost of capital is 5%, I might get 10 projects worth $100 million. I can project for that or budget for that. But let us assume my cost of capital from 5% went to 20%. So the viable investment opportunities with positive net present value will be very, very minimal. Only maybe one project or two. If you are using 20% discount factor as a cost of capital, most of the project will be negative net present value. So the relationship between cost of capital and the amount and number of investment opportunities available to the company will be less. So it is inverse relationship between cost of capital and number of projects that the company can take. And this is why I keep saying one of the finance manager role is to minimize the cost of capital by many tools available to the finance manager or the CFO. Then we will look into the cost of capital in relation to the security valuation. I did mention this in the first video that the higher the cost of capital, the higher the required rate of return, that means the lower the value. That means both the cost of capital has a negative relationship with both the projects that the company can take and the valuation of its security, which is the stock and the bond issued by the company. Let us look into a concept called marginal cost of capital. So what do we mean by marginal cost of capital? It means that the more you take project, the more capital you take from the market, the cost of capital will go up, because every time you go out into the market asking for loans, debt, or equity to finance new projects, so investor will tend to shy away, because every now and then you need more cash, while investor is expecting you as a company or finance manager to generate enough cash. So this is why your cost of capital will keep increasing the more capital, additional capital you take. And the number of investment opportunities available to you will be less. This is what I just mentioned. Let us take a graph that might make it easier for you to comprehend. So if I have in the y-axis the cost or the return, and on the x-axis amount of new capital, that means new capital is 0. While we move this way, we take more capital, new finance, debt and equity. And this one will be the cost or the return. This line represents investment opportunities available. As you can see, it is downward sloping. That means it goes down the number. If we have here 20 projects, here will be 15, here might be 10, 9, until we come to 0. And this line is the marginal cost of capital. That means if you have a cost of this level, let us assume here it is only 5% cost of capital. Okay? So your investment opportunity will be at the highest because you have a very low cost of capital. So you can take many projects. But as you take more debt from the market in the form of equity or debt, the cost started to go up. And simultaneously, investment opportunity will go down. Because now you are using higher discount factor, many projects will be out of schedule and will turn negative net present value. So the opportunities available to you will go down and the cost of capital will go up as you take more capital. Until you reach this point, we call it optimal capital budgeting. This is the number of opportunities that you can take. You can read it here. This is the maximum number of opportunities that you can take. Beyond this intersect, you will have cost higher than the return. This is the return on this. These are the number of projects available because the cost will go up and the return will be lower. You have a return here, for example, but you have a cost here. Then you will get a negative net present value. Let us move on and discuss the weighted average cost of capital as a discount factor to find out the net present value. If we use the weighted average cost of capital to the whole company to evaluate new projects, implicitly we are making two assumptions. The first assumption that the new project have the same risk profile as the profile for the company as a whole, because the weighted average cost of capital is the weight or the measure of the average risk for the whole company. So if you are going to use this figure to discount cash flow from new project, that means you are assuming that the new project has the same risk profile as the company as a whole, the same risk as the average risk project of the company. This is the first assumption. The second assumption, we are assuming again implicitly that the capital structure is the same as the company, because here the weighted average cost of capital is calculated based on the weight of the debt and the weight of equity. These two items, weight of debt and weight of equity, is called capital structure. How much debt we have in the capital structure of the company. So you will assume that the project life, 10 years, will have the same capital structure as of now. There will not be any change. We have a constant target of capital structures during the whole life of the project. And this is impractical because the capital structure keep changing. Also the risk might differ. So there is a different capital structure. You might take more debt, only debt to finance your project. So the capital structure will not be the same. The new project definitely will have a risk different than the company as a whole. So in such case, the analyst will use the provider of the money. Who provide the money for the new project? If I have new project, the money, the new finance, did it come from the company cash flows? In such case, we will use the weighted average cost of capital. We use weighted average cost of company in the valuation. Free cash flow, I'll come to this, belong to the company supplier of debt, that is debt holder and shareholder. That is the weight, which means the capital structure. If the money comes from the company itself without raising any new capital in the form of equity or debt, then you can use the weighted average cost of capital. What F means? We know so far in all the video we keep saying cash flows, cash flows. What is this F? F means free cash flow. Free of what? You know, if you see the cash flow statement of any company, it consists of 3 sections. Section 1 is cash from operation, which is the main or core business of the company. And then there is cash for investment, because company need to invest more to replace fixed asset to continue in the business. The difference between cash generated from the operation and cash used to buy new asset is called free cash. Free. Why we use it free? Because the company is free either to pay the debt or give it to the shareholders in the form of dividend, or both, which is the 3rd section of the cash flow statement. That is the financing activity, either paying or taking new debt, or paying to the shareholders, or issuing new shares. This is the weighted average cost of capital. We use this to discount the free cash flow of any project we are contemplating to take. This is the first case. That is, the money is provided by the company. But if the money is provided by one of the provider of debt or shareholders, then you use that specific case. For example, if you issue new shares, that is equity, to finance the new project, the analyst must use the cost of equity. The cost of equity if the cash flow belongs to the owner, such as dividend. So the owner of the company, if they provide the money, no debt, then you use that in the discount factor. Now we have different sources of finance. We have debt financing, we have equity financing, and then there is hybrid instrument. That is, instrument has both element of equity and element of debt, such as convertible debt. As of now, it is debt, but it could be converted to equity. So we call them hybrid instrument. There's so many sources. Let us see each source separately. We will start in this video the cost of debt and how to calculate the cost of debt. There are 2 ways to calculate the cost of debt: yield to maturity. I think all of you know this. And the second one is debt rating approach. Yield to maturity, we'll discuss it here, but for now, let me talk a little bit about debt rating. Each company has a credit rating. If it is very high credit rating, A, it will take, or AA. There is 3 companies, Fitch and so many, 3 companies mainly, they rate the new bond. If you issue new bond, the bond will be rated A, B, C. C is the lowest, so you have to pay very high because the risk is high. But if it is A rated, you can pay interest very small. This is what is meant by debt rating. But let us see what we mean by yield to maturity. This means that we assume that the bondholder hold the bond until maturity. That means if you buy the bond today and the remaining period for the bond is 5 years or 6 years, what return you will get if you hold on to this bond until the maturity date and then get the original amount, normally $1,000, from the company. What yield, what return you are going to get until that maturity. This is what is the meaning of yield to maturity. This is a return to investor if he or she purchases a bond today and hold it until maturity. So there is equation to this, how to calculate the yield to maturity, and it is very daunting when you look at it, but if you go to my first video, you'll again find it so simple. That video, as I mentioned on that video, this is central concept in the whole finance. It keeps coming in every video so far. Now we are in the video number 11. I keep bringing the same formula each video. So, this scare everyone. But if you remember the magic formula, the net present value equal future cash flow 1 plus R. This is simply the whole scary figure like this. Let us see what does that mean. Price today, the price of the bond today. How much you buy this bond? You can find it in this way, which is the present value of all future cash flows. This is the payment. Payment in year 1, payment in year 2, payment in year 3, until payment in year N, which is, let us say the bond has 10-year maturity. After 10 years, you will get the 10,000, sorry, the 1,000 value after 10 years. So N will be 10. We keep adding. Instead of writing all these dots, they put it this way, which means this is the summation sign. The sum of the payment for the years and 10 years is starting from year 1, T time 1, because this is time 0. So we get it after 1 year. So this is starting from time 1 until time N. The sum of which is the plus plus plus. All these pluses are this sign, sum of all these, divided by 1 plus R. That is cost of debt. Why divide 2? Because the company pays semi-annually. Because the company pays semi-annually 5%. So 5 divided 2, you'll get 2.5 for 6 months, because you get it every 6 months. This is why if it is quarterly payment, we divide by 4. And T is the time plus the fair value. That is the future value you get after 10 years. That is the 1,000 value of the bond, or the nominal, the face value of the bond issued for $1,000 collected by the company. They will repay you the 1,000 after N years, that is 10 years. So simple. We will take a practical example to understand this fully. Let us say this company issued a bond to finance a new project. The bond pays has a face value 1,000, and it has a maturity date after 10 years. So after 10 years, I will get this $1,000, and today I will pay the company 1,000. Okay. The bond pays 5% semi-annually. That means 2.5 every 6 months. Coupon bond. Upon issue, the bond sells at 1,025. So today's value is 1,025. If you go to the market and buy this bond, you have to pay 1,025. So this is the value today as per our equation. What is the company's before tax cost of debt? When he says before tax, that means ignore 1 minus T in this calculation, so that we don't want to complicate it. Let us go and see how to set answering this question. The value today, which is 1,025, I'm going to buy, should equal the future cash flows discounted at the maturity date, yield to maturity. That is the rate we are looking for. We again use the golden rule, value today, which is the 1,025, equal all future cash flows divided the required rate of return. This is the equation on video 1. Present value of expected future cash flow. We use expected because it is in the future. We expect to get that payment. Although it is fixed by contract, but the company might go bankrupt. So this is why we say expected. And then we introduce 1 plus R. We explain why we are introducing N. Let us not repeat this. So the equation will be so simple. The value today, which is 1025, equal present value of expected future cash flows. What are these cash flows? There are 2 types of cash flow. Interest payment that I get every 6 months, and the original amount I'm going to get after 10 years. So let us calculate first the present value of future interest payments that I receive every 6 months, which means future cash flows divide 1 plus R. Again, the summation 20 times, while the years are 10, because it pays twice a year, semi-annually. That means you get in June and December. So you will get 20 payment, not 10 years. Starting from time 1. You will get $25 every 6 months. Why? 5% into 1,000 will give $50. $50 every semi-annually, that means I will get 25 in June and 25 in December. That is the $50. Divide 1 plus R or I. This is what we are looking for, the yield to maturity. So the equation will be missing this only. Plus, as I said, the 1,000, the fair value of that 1,000 in the future. So we have to discount the 1,000 as well. 1,000 divide yield to maturity, which we are looking for, raised to the power 20. This equation, I think you could do it in a scientific calculator, but let us do it in the Excel. I'll show you how to do it on Excel. So this is the Excel sheet. We have time 0 today, and then 20 payment of 25 each, correct? This is the semi-annual payment of interest. In year 1, I'm going to pay negative cash outflow, 1025. This is the one. So this should equal the whole cash flows. That means let us calculate the IRR. IRR is the rate at which the cash flow equal 0. So I write IRR and then find out the value of the IRR. This is the value. Let us have more spaces. Okay, so now discount factor in year 1 is 0 equal 1, because we don't discount this because this is in year 1, so it has the same value. And then let us drag this into this. Now, how to calculate the discount factor? The discount factor simply means equal 1 divide 1.06, this value, 0398. Subsequent to that, we say this divide 1, the same figure, and then we drag the same equation. We drag the equation, but don't forget we miss here. We are going to get 1,000 also. We missed that. 1,025. The 1,000 after 10 years, the face value plus the last 25. So the equation, now this is the new IRR. Let us plug in the new IRR. 2, 3, 4, 2. And then we use the same here. 2, 3, 4, 2. So let us see the value. This should equal 0, correct? Because we said IRR will discount the value at which the present value of all cash flows will equal to 0. Is this true? Yes, it is 0. That means this is the semi-annual rate, so the annual yield to maturity this time too. That means this is 4, 6, 8, 4. 4, 6, 8, 4. As we have just calculated on the Excel sheet, the answer is the annual yield to maturity is 4, 6, 8, 4. I think with this we come to the end of video number 11. You are reminded to subscribe to the channel and hit the notification bell so that you get notified whenever I publish a new video. Thank you.